You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Monday. As I told you on Friday, today we're going to take a look at TerraVest Industries, ticker TVK.TO, a small cap that is quite exciting, actually. And like the first thing I'm asking myself is this bull run over, or is it going to continue like there's no tomorrow? So we're going to talk about that today. Up 180% in the past 12 months, and up almost 500% over the past 3 years, and up over 900% over the past 5 years. Kind of crazy. Of course, you look at this and then you get hit by FOMO, like fear of missing out. It's like, damn, I should have put this one on my radar sooner. Unfortunately, it was not possible for me because it would have not met my criteria, as the company didn't increase its dividend until the end of 2022. So since then, we have like three dividend increases, so once a year, but we see also that the revenues are like going up like crazy. So as of December 2021, we had a trailing revenue of like 356 million, and now we're on pace to reach $1 billion in revenue in like somewhere in 2025. It continues to go that way. Earnings per share are also growing. So now the company is showing a strong dividend triangle where I can see revenue is increasing. So the past 5 years, the revenue growth has been 24 annualized growth rate. So kind of crazy. Earnings per share up 21.5. So 22% annualized growth rate over the past 5 years. And the dividend is increasing fast. So only 3 years out of 5, but still showing 8.5% annualized growth rate for the past 5 years. So you can see that now it increases its dividend by double digit, and the payout ratio is like actually super low. So a lot of things to tell me that this company is on fire, but those are numbers. Now, the most important part is to understand where those numbers are coming from, what's the company's doing, and if the hype is over and I'm just too late on this one, or maybe it's going to continue to grow. So first things first, keep that in mind. When you look at such an amazing business, keep an eye on the market cap. Market cap right now is at 2.6 billion. So that was, even at 2.6 billion, I would consider it as a small cap. The technical definition is anything under 2 billion at this point, considering the market grows and grows and grows, and we have like companies showing now $1 trillion in market cap. I would say that anything below 5 could probably be considered as small cap. So anyways, it used to be a very small cap. Now, of course, after like the price doubling, tripling, quadrupling, and so on, you get some kind of like interesting market capitalization, but expect a lot of volatility. That is like number one. So now let's take a look at what they do. So they are selling a lot of like products around oil storage, heating and cooling products, propane tanks, water storage, natural gas storage. So when you're thinking about everything that is like storage tanks, vessels, and then you have like home heating products, cooling products, everything around the energy that is around there. And they have added the maintenance part as of late. So this section is now growing quickly. The playbook for this business is, of course, it is, those kind of products are in high demand, and they grow both organically and through acquisition. Actually, funny story, they I don't know when, but a while ago, they acquired Granby Industries. So the city where I live in Quebec. So there's a little bit of TerraVest around the corner where I live. So I found that quite interesting. And yeah, so every year they are making a lot of acquisitions, and that is fueling a lot of the hype behind the stock. So the hype is kind of like justified in the sense where cash flows grow quickly. So cash flow from operation was up 49% last quarter when they reported in I think in December, and 97% for the full year. So doubling cash flow from operations, kind of crazy, right? During the same period, as I told you before, the stock jumped almost 200%, so by 180% exactly. Earnings per share during the same period jumped by 42%. So first thing that you have to consider is there's a red flag. There's a red flag when you have the stock price going up like there's no tomorrow, but the earnings are not following. Why it's a red flag? And it's not a catastrophe, but it's just like something that you have to keep in mind. Right now, you're paying more, so the like it's a higher multiple for today's company value than it was a year ago, and then a lot more in this case. So we are talking about PE expansion. What justifies PE expansion? Well, a few things actually, and there are like a few reasons sometimes that are quite good. So when you have a company like this that trades at a higher price, but the earnings are growing but not as fast, well, the market is expecting more growth. You will also hear the expression price for perfection. So of course, TerraVest Industries, if it starts to report like 5% revenue and earnings growth going forward, no more acquisition, you can expect the stock price to drop. Because right now the market is willing to pay a premium for the growth aspect. So they expect the company to keep on growing by acquisition, using the same playbook, and of course, increasing their cash flow along the way. So it's one thing to grow, but you don't want to bloat. Because if you bloat and then you just report higher revenue growth, but then your expenses, administration charges, amortization, they're all earning your earnings, and then the earnings are not growing. The cash flows like stagnates because you have like too much money to spend on integration and paying for more people, and then the price you paid for the acquisition is a little bit higher. Well, then it's not going to look good. So you have to keep that in mind. Of course, if TerraVest starts to report mid numbers and disappoint analysts, the stock price will drop, that's for sure. But at this point, there is a high possibility that the company keeps on the same playbook and it will continue to work, and people are willing to pay the premium for that. So there are a lot of acquisitions that are available, their pipeline is full, and as long as they maintain this business model, like chances are it's gonna work out well. One thing that I love is the fact that they have added the maintenance over those product, like eating and cooling products over tanks and stuff. So what is great is you make the big sell first, and then you have kind of like a recurring revenue with a good margin. So that should help maintaining a more stable cash flow down the road, and without like being forced to make acquisition every single time. So that's an interesting point. So that could happen, but the opposite could also happen. So it's really hard to maintain the cap of being a unicorn forever, right? So maybe you're going to see something similar to Amin Power, HPS, actually, that went up super fast. Similar profile in the sense that it is a small cap. It went up very fast, but now starting like mid 2024, the stock price went up and down and up and down, but there's no clear direction anymore. So we're not there yet for TerraVest Industries, but this is the type of possibility that could happen. So keep that in mind. It is like a high risk, high reward type of play. But I see a lot of opportunities and a lot of juice there. So the downside is, of course, by paying a premium for the valuation, you are acquiring a stock price for perfection. That could hurt. So it will be interesting how the story developed for TerraVest. One thing I don't like too much is when you go around on the website, it is typical for small cap, you do not get much information. Like if you go on the investor's website and you click on investor's presentation, the only thing that you'll see there is more information to follow. So you have to dig into the financials, which are a little bit harder for most people. You can read the press release, so that's good, but still, it's going to be a little bit tougher to get more information over there. So just keep that in mind as well while you are doing your research. If you are interested in going for those companies with a strong dividend triangle and a thriving business, I suggest that you download the Rockstar list at moosemarkets.com/rockstar. It's tough to invest at a all-time high market, but the solution is often found into buying quality companies. And by quality companies, I mean companies with robust financial metrics. You can tell the story that you want, but if you don't buy companies with growing revenues, growing earnings, and growing dividends, you are taking bets. And taking bets in the stock market when the market seems to be overvalued, probably not the best thing that you should do. So download for free the Rockstar list at moosemarkets.com/rockstar. You'll get a long list of companies with robust metrics being covered on the Canadian and the US market. All right, Moose, that's enough for today. Tomorrow, we are reviewing CP and CNR. So the whole railroads, Canadian railroads earnings. So we're going to talk about that, talk about some dividend increases as well. So that's going to be nice. And we'll see where the economy is going with those railroads. All right, take good care and don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.